See, so at the end it approaches to, it means we retired this bond. It means some parts of this bond discount is decreasing and the value of the bond started increasing. It's slowly adding to the value of the bond, right? And at the end it is a plug value. Simply you just see, we just add the value here. It's going to be one here. So bond carrying value increases from 96,149 to 100,000 at the end, right here. So what happened to this discount balance? It decreases and it is allocated to interest expense through amortization, and this is the additional expense of the interest over and above the stated period, which means the interest payments which are based on coupon rate would be less than interest expenses, right? Our interest expense is going to be higher, and there is a logic behind that, because you issued the bond at discount, because the nature of the discount is capital expense, right? You issued the bond for 5 years, so this discount is also belong for 5 years. We cannot just directly add it to our income statement, so we divide this, or we spread this discount for 5 years, and then we take it down on yearly basis, right? So slowly we gonna increase our interest expenses, but payments are based on coupon interest rate. So the amount of interest expense increases as bond carrying value increases towards maturity, right? Because bond value start increasing with time. Why? Because 96,149 would eventually in 5 years will become 100,000, because at the maturity bond value must be, or market value of the bond must be equal to the face value or maturity value. That is obvious. Okay, so this is just a graphical representation, right? So you issued the bond at discount, so at the end you have to pay, you pay back the exact 100,000 at the end of the period. So this is the issue of the bond and the relationship between payments and expense. So when the bond is issued at discount, interest expense is always greater than interest payments. Interest payments are smooth out, right? It's horizontal line, and interest expenses start rising, right? So this is the relationship between the bond value and the face value. You see, at the start the bond value was 96,149, and it started increasing until it reached here. Then bond value will be equal to face value or maturity value at the end of the 5 year or maturity period. So what would be the entry? How are we going to record our interest expenses? So we have illustration here. So this is 1 year amortization schedule. So Southwest journal entry to record interest expense and interest payment for the 6 months would be follows. So on July 1st, when the first interest is due, which is recording this, what would be the entry? It would be the interest expense to discount to cash, right? So they, how much they pay? They actually pay 4,500. This amount, what is stated on the bonds face value, a bonds face, which is 9% semi-annually. So after 6 months they have to pay 4,500, right? But we are recording our income statement with this amount, so the difference is here, right? So entry would be interest expense to discount and cash, right? Okay. And for December 31st, when we have to record this, so the year end at December 31st, but payment is on January 1st, which is next day. But we have to make our statements on this 31st of December. So it means we are not paying them cash, we create liabilities. So what would be the entry? Entry would be interest expense to discount to interest payable, right? And next day on January 1st we pay back, right? So I have just pasted a very nice tidbit here, or stop and think question, concept checker. Just read it and see the answer and try to understand that. I'm just gonna paste the answer here, right? If you don't understand that, we'll discuss in our, okay, let's discuss here as well, because I think it's uh, good to discuss here rather in our Zoom meeting. Okay, so the question is, what would Southwest Airline 2014 income statement and yearly end balance sheet reported for these bonds? So the income statement going to be interest expense, both this is going to be 6 months and 6 months, we added. So this total expense is greater than the actual payments we pay on yearly basis, right? So but we also add $630 of discount as well, right? So how are we going to record it on our balance sheet? On our balance sheet, you see our discount is decreased, right? So every year the discounts start decreasing and the value of the bond start increasing and approaches to 100,000, right? So I have pasted in an illustration here. Just read that and we try to solve it together. Okay, so we have a company issued 600,000 value of bond, 5%, and this is the maturity date, 10 years. The market rate was 6%. Look at that. It is discount or premium? It is discount. Why? Because market is giving us higher rate than the company. So company issues worth of $500,000 bond and receive 462,808, right? So did you notice that we have two issues price? This one is authorized by the government or by the authority or by the board of director whatsoever. So the law authorizes company to maximum can raise 600,000, but they raise 500,000, right? So you focus on this one, that is just their maximum amount, but they actually go for first 500,000. Okay, so this is extra information. Don't just worry about this 600,000 where it goes, right? Here, this is the data, and they are paying semi-annual interest rates, and semi-annual interest rates are on June 30 and December 31st. So first of all, you have to make first 4 semi-annual interest periods, right? It means for 2 years you have to make amortization table, and then you have to record it for 2 years entries as well. Let's talk about or solve.